Hi everybody, this is Ivan Alon, the founder and chief investment officer at Aligned Wealth Advisors Investment Management, also known as AWAIM. So today I'd like to speak a little bit about what's behind me. This can be found on our website under the For Advisors tab. And if you go to Research Highlights, you'll see it's the most recent one from February 7th. And this graph behind me actually goes back all the way to 1949. What a great year. And essentially, it shows the output gap. And a lot of you are not going to know what the output gap is, and I don't expect you to have much familiarity with what the output gap is. But it is a very interesting economic metric that can give great insight into inflationary pressures when the economy has more inflationary pressures versus times when it does not. And so when the output gap is significantly positive, like it is right now, it is indicating a very inflationary environment for the economy. When it is significantly negative, it is not an inflationary, could even be a deflationary period. Currently, the output gap is significantly positive. And this output gap, which essentially measures the amount of overworking of an economy. Is the economy being overworked relative to capacity? And so there is this, economists like to look at issues like the capacity of an economy to produce a certain level of goods and services given its resources, whether it's labor and other inputs of production. And so this output gap, when it's significantly positive, indicates that the economy is producing beyond its sustained normal or what I would say sustainable rate of production. And so it's being overworked, it's being stressed out essentially. And that is not sustainable. And so you see over time this undulation with this output gap oscillating between being significantly positive, significantly negative, back and forth throughout economic history. And of course, it's an elegant dance with the economic cycle and the business cycle. And so we're very much still in this phase, this inflationary phase. This particular research highlight was published on February 7th. On February 13th, just a couple of days ago this week, the inflation print was shared from the government, and it looks like inflation is not really abating significantly. It ticked up a little bit from the prior print that we had the month before, and that was the reason why the market tumbled a few hundred points, because there's this concern that maybe inflation isn't over. So this whole research highlight that was published last week is exactly to that point, that unfortunately it looks like we will need to have a recession. A recession will do a very good thing for the economy over the long term by really resetting pricing in the economy. And maybe if we're really lucky, not only should we see significant disinflation, which is just the slowing of the rate of inflation, slowing of the growth rate of inflation is disinflation. Doesn't mean that you're getting prices going down. It just means prices are not growing as quickly, positively growing. But they're still growing, and they're still growing on this massive amount of growth of inflation we've had over just the past 3 years. And so a recession would provide an opportunity to actually have some deflationary opportunities for consumers, which it's certainly quite welcome to middle class, lower class constituents within the economy are really affected much more substantially with inflation. And so deflation would be very, very helpful to actually see the price of things go down. Keep in mind, the price of things are up more than 22% over the past 3 years. And so this is a significant price level increase across the board. Obviously, some sectors have had much more egregious inflation than others. And then to see some price reduction, just a little bit of price reduction, maybe you get back to an 18% cumulative level of inflation over the past 3 or 4 years. That's still significant, but that would be very helpful for the economy and for a reset. But all of this essentially means that higher interest rates are absolutely more likely than not over the next few years. And of course, this has major implications for the capital markets, for the fixed income, bond markets, corporate bond markets. Tremendous amount of issuance was done by U.S. corporations in 2020 and 2021, and most of that issuance was 5-year term paper, and a lot of that paper is coming due next year. So there's some big refi risk that corporations are, and specifically CFOs, are doing a very careful analysis of how to deal with that. And payrolls are one of the most flexible areas of an income statement of expenses to deal with that. And so that is one of the reasons why we forecast that there is likelihood to see many more layoffs, mass layoffs, and seeing the unemployment rate tick higher into the 4.2, 4.5 range, which may be the level at which we are experiencing a recession. But at this point, we haven't seen that yet, and therefore inflation is still very robust. So check out this research highlight. My upcoming Forbes article is also riffing on this same theme, and it's entitled unfortunately, hoping for a recession is necessary at this point. Something to that effect. That's what the title sounds, has a little bit of that context in it. The editor may change that title a little bit, but it is a strange position to be in, which is hoping for a recession is actually a very positive thing for the economy and for the market participants over the long run. And of course, that means being prepared for such a thing to occur in the marketplace, being prepared in your investment portfolios accordingly. There are certainly things you can be doing, and certainly things we're doing here at our firm for our client portfolios to prepare for a true recessionary environment, but also make some opportunities out of that as well, which would likely show up, and we're prepared for it to show up primarily in the non-US equity markets as well as the fixed income markets. But we're not quite there yet in the fixed income markets. And so we've got a lot of dry powder on that front. If you have any questions or would like to discuss more, please feel free to give us a call here in the office, or otherwise just send us a email through our website, and look forward to seeing you again next month.